years, those 5 years, and those 5 years, but there's always some risk. Which of these, 5, 10, or 15, has the most risk for the client? The 5-year period certain. The shorter the period certain, the more risk for the client. Hence the what? Higher or lower the monthly payment? Higher. The higher the risk, the higher the monthly payment to the annuitant. Now, maybe your client doesn't want a period certain. They want to have a guarantee that should they die before they get all their money back, which in my example is getting paid to the client over the next 20 years. They want to know that that money is guaranteed. They would want to choose life income with refund. Life income with refund has a beneficiary for the account balance, which is going to be paid out, in my example, over the next 20 years. Now notice, does that mean they have a beneficiary forever? No. The annuitant gets paid for life, forever. So if they outlive their money, the insurance company has to dip into their pockets and pay. An annuity works the opposite of life insurance. With life insurance, you're betting you're going to die. With an annuity, you're betting you're going to live. And the insurance company, of course, is betting you're going to die. So to have a refund annuity, it says that if you die at any point in this example over the next 20 years, the rest of your account balance will be paid to your beneficiary. And there's two different kinds of refunds. There's a cash refund, which just means in a lump sum, or they can choose the refund as monthly payments, which is called an installment refund. So that if I died at 62, do I have a beneficiary? Of course. What if I died at 72? Yes, I would still have a beneficiary. What if I died at 82? Would I have a beneficiary anymore? No, because in my example, they think, the insurance company's tables, expect me to die at 80. But when did my payments stop? When I died. So if I live to be 99, my payments will continue until I die. So life income with refund has no risk to the annuitant, would have the lowest monthly payout of the 3 that we have discussed so far. The fourth payout option. Now remember, once a payout option is selected, it cannot be changed. You cannot suddenly say, oh, now I want to do joint and survivor, or now I want to take all the rest of my money out. You can't. Once you do it, once you choose it, you're locked into your payment. So the fourth choice is called joint life. This payout option uses 2 or more lives, but typically husband and wife, and it's designed to pay out until the first party dies, and then it stops, which is kind of weird, I think. Much more common is called joint and survivor. The joint and survivor payout option, husband and wife annuitize, it is designed to pay out until the last party dies. So if this is my annuity and I annuitize, my husband and I annuitize, and if he dies at 68 and I die at 98, when do the payments stop under joint and survivor? When I die. Sometimes they do go down at the death of the first spouse, but that's entirely up to the insurance company. So joint and survivor pays until the last party dies. Then it ends. So those are the 5 annuity payout options that you must feel comfortable with. Page 7 discusses the different types of annuities that you can have. So the different ways you can get money in. The first one we actually already talked about, you didn't even know it, but it was a single premium where we paid in $50,000. It was in after-tax dollars, of course, and we were not annuitizing right away. We were going to annuitize in the future. So that is what is called a single premium deferred annuity. Deferred simply means that the payments are going to start at some point later on in the future. So single premium deferred annuity. A level premium annuity. A level premium annuity, you wouldn't put in this big large sum. Maybe you put in $100 a month. It's also deferred. You can't annuitize right away in the beginning $100, right? So single premium, or it could be a level premium. It's important to remember that during the pay-in period of an annuity, it is very flexible. It is very flexible in the fact that you are allowed to put in more or less than you were planning on putting in. They'll take your money, as much of it as you'd like to give them. So you could have a level premium or a flexible premium where you put in $50 this month and $500 next month and $20 the next month. That would also be a deferred annuity. A flexible premium has to be deferred. You can't have an immediate annuity unless, letter D, an immediate annuity would have to be funded with a lump sum. So let's say that you put in a single premium, $50,000. Let's say you were 60 and you decide to annuitize right away. The only way you can fund an immediate annuity is with a single premium. So what are you in? Pay in or pay out? Pay out. What kind of units do you have? Annuity units. And with this single premium immediate annuity, the payments start 1 month later. The payments start 1 month later. With an immediate annuity, you pay in your premiums in a lump sum. This is after-tax dollars, and you are in the pay-out period. In a variable product, you would have annuity units. The payments on an immediate annuity start 1 month later. Not the next day, but 1 month later. You can only fund an immediate annuity with a single premium payment. We talked about during pay-in period on an annuity, you have earnings that are tax deferred, but we didn't talk about what are those earnings. You can have 3 different types of annuities. The first one I would like to discuss is a fixed annuity. With a fixed annuity, just like traditional whole life, the premium payments go into the insurance company's general account. And from our discussion earlier, you already know who has the risk in the general account? The insurer. So in a fixed product, the monies go into the general account, which has a guaranteed G&G interest rate around 4%. And the insurer promises to pay to the annuitant 4%, no matter what it is that they earn. So in a fixed product, your money goes in and earns 4%. But what kind of risk do you have? You have inflationary risk. Hence along came the variable annuity. With a variable annuity, the rules apply just like before. You must be registered with the NASD. You must hold your Series 6 or Series 7 license and your life and variable license. With a variable annuity, you are going to have lifetime payments of a variable amount. With a fixed annuity, you had fixed payments for your life. With a variable annuity, how much you get monthly will fluctuate. So with a variable product, the money does not go into the general account. There is no guaranteed interest rate. Where does it go? Into the separate account. Who has the risk in the separate account? The insured, the annuitant in this case, but the client does. What's the guaranteed interest rate? There is none. So with a variable product, they keep pace with inflation, well at least they have in the past. They're commonly called a hedge against inflation. Variable annuities. Fixed annuities have great inflationary risk. A variable product is commonly called a hedge against inflation. They get paid for life a variable amount monthly. Letter G at the bottom of page 7 is your equity indexed annuity. So an equity indexed annuity is not classified as a security. So you do not need to have a securities license in order to sell an equity indexed annuity. You can sell an equity indexed annuity with just your insurance license. Equity indexed are types of fixed annuities that have a guarantee as to how much you put in, the principal, and the interest. They usually have their cash value tied to a specific index. For example, indexed against the S&P 500, so that if the cash value does better than the benchmark index, if you will get credited with extra earnings into your general account. Equity indexed annuities. You do not, once again, you do not have to have a securities license in order to sell these products. The premiums do not change based upon the performance. It is the cash value that will fluctuate, where you might get, if the separate account, or if the general account, if the general account does well, you might get more in your cash value than you were expecting. So the equity index products. So those earnings that are in the pay-in period are tax deferred. Could be a fixed product, it could be a variable product, or an equity indexed product. That is our discussion of annuities for the purposes of our insurance test.